there, everybody. Thomas Wood with Basecamp Trading. It is Friday, March 17th, and we're going to take a look at one of the setups from the trading room today. Ended up working out fairly well, and that was a channel breakout in bonds, on 30-year bonds. Now, the thing is with bonds, we were actually, and we still are, looking at a bearish divergence on our 120-minute and 240-minute price charts. And you can tell that there's a bearish divergence. You look at your two pivot highs. This is the 240 here. Here's pivot high number 1 and the current price here. Pivot high number 2. You see how we have lower momentum on the indicator line and the histogram? So that's what's called a bearish divergence. So that would say if we can break the previous bar's low, that it would suggest it's going to move lower. All right, now keep in mind, with every setup that we trade here, there's always the setup portion and then there's the trigger. The trigger is, for example, with a bearish divergence, breaking the previous bar's low to then say, okay, now we should see it start moving our direction. We never just sell from the top as it's climbing or buy from the bottom as it's selling off. All right, now that being said, intraday, you drill down and look at what happened today. Bonds had a really well-defined channel here on the 500 tick. You can see resistance was hit at 148 and 430 seconds 3 different times, and we were looking for a short if it broke down below 147 and 27 seconds, which it never ended up doing. But you can see here what ended up happening is we formed a channel and then we ended up breaking out of the channel to the upside. All right, now the interesting thing about it is when you broke out, look at the momentum short term. All right, we had stronger or strengthening upside momentum. You can see the histograms on the upside were getting bigger, histograms on the downside were getting smaller. So we had weakening downside strength, increase in upside strength, and then we broke out and we followed through pretty good all the way up to retest yesterday's highs. So keep that in mind. Ended up working out. Nice job to everybody in the trade room today, but keep in mind that there's always two parts to every setup. There's the setup itself, and then there's the trigger when you actually get in. So another example was earlier today we were looking at a potential head and shoulders forming in crude oil. And crude never triggered the head and shoulders, and it ended up not being a head and shoulders. For example, with a head and shoulders pattern, your trigger is when you actually break the neckline of that head and shoulders, which never happened. So therefore the head and shoulders becomes invalid and there just was no trade. All right, so keep that in mind. There's a setup and a trigger to each trade. All right, that's all I have for you for today. I will see you in the trade room bright and early Monday morning. Have a great St. Patrick's Day. And until next time, happy trading.